Most people believe investing is complicated because the financial industry often makes it sound intimidating intentionally. Complex terminology, market predictions, endless opinions, and emotional headlines make beginners feel like investing is only for experts or wealthy individuals. But the truth is much simpler. Investing is the process of putting money into assets designed to grow in value or produce income over time. That is it. The reason investing matters so much is because earned income alone usually does not create long-term financial freedom. Working for money has limits because time and energy are limited. Investing changes the equation because money itself begins producing more money independently. This is one of the biggest mindset shifts in wealth creation. Most people spend their entire lives trading time directly for income, while wealthy individuals focus on building systems where assets continue growing even when they are not actively working every hour. The earlier someone starts, the more powerful compound growth becomes, because time is one of the greatest advantages in finance. Small investments do not look life-changing immediately, but over many years, compound growth accelerates dramatically. This is why wealthy individuals often focus heavily on consistency instead of intensity. Market crashes, economic uncertainty, and financial headlines create emotional reactions that scare people away from long-term investing. But wealthy investors understand volatility is normal. Markets move up and down constantly in the short term, while historically growing over long periods of time. Successful investing is usually less about predicting the future and more about remaining disciplined long enough for compound growth to work. Most financial success comes from behavior, patience, and consistency rather than intelligence alone. The first thing every investor must understand is the difference between assets and liabilities. Assets put money into your pocket or grow in value over time. Liabilities remove money from your pocket continuously. Most financially struggling people spend almost all of their income acquiring liabilities, while wealthy people focus on accumulating assets. Stocks, ETFs, real estate, businesses, and dividend-producing investments are examples of assets because they can generate future income or appreciation. Luxury purchases, unnecessary debt, and excessive lifestyle spending often become liabilities because they create future costs without increasing wealth. The second thing beginners must understand is diversification. Diversification means spreading investments across multiple assets instead of relying on one single investment or company. This is why many successful investors prefer index funds and this approach reduces risk while still allowing long-term market growth. Most beginners lose money because they react emotionally to fear and excitement. They focus on long-term systems instead of short-term emotions. They understand that markets move in cycles. Temporary declines are normal. Emotional reactions usually destroy more wealth than market volatility itself. Another critical lesson is that investing should never rely on money needed immediately for survival. Emergency savings should exist before aggressive investing begins because financial pressure creates emotional decisions. Someone constantly worried about paying bills is far more likely to panic during market fluctuations. That is why strong financial systems matter before investing heavily. Another major concept is dollar cost averaging. This means investing consistently on a schedule regardless of market conditions. Instead of trying to predict the perfect time to invest, disciplined investors continue investing steadily over many years. This removes emotion from the process and allows compound growth to work gradually over time. Another major part of investing is understanding retirement accounts and tax advantages. Many people lose enormous amounts of future wealth simply because they never learn how these systems work. Retirement accounts like 401ks, Roth IRAs, and traditional IRAs allow investments to grow with significant tax advantages over time. Wealthy individuals often maximize these accounts early because they understand taxes quietly destroy long-term compounding if ignored. A Roth IRA, for example, allows investments to grow tax-free under certain conditions, which becomes extremely powerful over decades. Another important principle is long-term ownership. Wealthy investors often buy assets they believe will continue growing over many years instead of constantly chasing short-term trades. The financial media encourages constant activity because emotional reactions generate attention. But most successful investing is surprisingly boring. It is patient, repetitive, disciplined. Wealthy individuals often focus more on time in the market than timing the market. Higher returns usually require accepting higher volatility. This is why investment allocation matters. Another critical concept is dividend investing. These dividends can either provide passive income or be reinvested to accelerate compound growth further. Many wealthy individuals eventually focus heavily on cash flow producing investments because recurring income creates flexibility and financial independence. Another major mistake beginners make is waiting too long to start. Many people believe they need large amounts of money before investing matters. But consistency matters more than perfection. Starting small today is usually far more powerful than waiting years for the perfect time. Time is one of the greatest assets an investor can possess because compound growth rewards patience more than intensity. Another overlooked factor is lifestyle inflation. Many people increase spending every time income rises instead of increasing investing. Wealthy individuals often reverse this pattern intentionally. They increase investments before increasing lifestyle. That single behavior dramatically changes long-term outcomes. Now we need to discuss the psychology of investing because this is where most people fail. Investing sounds simple logically, but emotionally it becomes difficult because markets trigger fear and greed constantly. When markets crash, people panic because they feel temporary losses emotionally. When markets rise rapidly, people become greedy and reckless. Wealthy investors usually succeed because they remain disciplined during emotional extremes. They understand that investing is not gambling when approached correctly. Gambling relies on emotion and unpredictable short-term outcomes. Investing relies on long-term ownership, patience, and systems. Another important principle is ignoring noise. Financial headlines are designed to create emotional reactions. Every day someone predicts a crash, recession, collapse, or disaster. Another major factor is financial education. Better decisions repeated over time create massive advantages. Another important concept is understanding inflation. This means money sitting idle often loses value gradually, while investments historically outpace inflation long-term. Successful investors often automate contributions because systems reduce emotional decision-making. Automatic investing creates consistency even when motivation disappears. Another major mistake beginners make is chasing fast money. Social media constantly promotes unrealistic investing expectations, risky speculation, and overnight success stories. But real wealth building is usually much slower and more disciplined. Wealthy investors focus on repeatable systems instead of gambling emotionally for fast results. They understand that preserving capital matters because recovery from large losses becomes increasingly difficult over time. The final part of investing is understanding that wealth building is ultimately about freedom, not just money. Most people think investing is only about becoming rich someday. But investing is really about reducing future dependency. Investments create options. Options create flexibility. Flexibility creates peace of mind. Wealthy individuals often define success differently than average consumers. Success is not simply owning expensive things. Success is having control over your time, choices, and future. Another important principle is consistency during difficult periods. Most investors quit too early because progress initially feels slow. The people who succeed are often not the smartest. They are the most consistent. Social media creates unrealistic expectations around money constantly. Another important shift is understanding that investing should support life goals instead of replacing them entirely. Money is a tool. Another powerful principle is increasing income intentionally while controlling lifestyle inflation. More income accelerates investing only when spending remains disciplined. Otherwise, higher income simply creates higher obligations. Another critical factor is patience. Compound growth feels invisible before it becomes extraordinary. Many people stop too early because they expect dramatic results immediately. But eventually investments begin compounding faster. Cash flow increases, stress decreases, and financial flexibility grows. That is when the system truly begins changing someone's life. The Complete Investment Guide is not about finding secret shortcuts or predicting markets perfectly. It is about building disciplined systems that continue growing steadily over time. Start early, stay consistent, invest regularly, control emotions, focus on ownership, protect future flexibility, ignore noise, let time and compound growth do the heavy lifting. That is how real wealth is built. If this helped, then like and subscribe to the Daily Yield, because we're building real financial progress, one step at a time.